The war in Iran is thousands of miles away, but it is about to show up in your energy bill, in your mortgage payment, in your grocery prices, in your petrol costs, in every dimension of your household budget that depends on energy prices remaining stable and interest rates remaining low. And the speed at which this is happening should alarm everyone who thought the cost of living crisis was finally ending. Let me show you exactly how quickly the financial impact has materialized, because the numbers are stark and the timeline is immediate. In the United Kingdom, the probability of a Bank of England rate cut this month collapsed from 80% to less than 30% in just 72 hours. On Friday, before the strikes on Iran, markets were pricing an 80% chance that the Bank of England would cut interest rates at its next meeting. By Wednesday, that probability had fallen below 30%. Traders now expect just one rate cut by the end of the year, down from 2 last week. One rate cut instead of 2. A probability collapse from 80% to 30% in 72 hours, based on events in the Middle East that most people think have nothing to do with British interest rates. But the connection is direct and immediate, and it runs through energy prices. The National Institute of Economic and Social Research modeled what happens if oil and gas prices increase by 30% and 50% respectively over 1 year. The results are devastating. Inflation would accelerate in 2026 and into 2027. And the Bank of England base rate would climb to 4.5%. The current rate is 3.75% after 4 cuts in 2025. All of those cuts, all of that progress toward lower borrowing costs would be reversed if the oil shock persists. Mortgage holders who finally got relief would see that relief disappear. The cost of borrowing would climb back to levels that crush household budgets. And this is not a speculative scenario. This is a modeling exercise by one of Britain's most respected economic research institutions, based on price increases that are already partially materializing. Oil has surged above $85 a barrel, its highest since July 2024. Natural gas prices in Europe have spiked. The conditions that feed into the 4.5% interest rate scenario are building right now. Now let me show you how energy bills are being repriced, because this is where the war becomes a direct tax on every household. Just last week, there was cause for celebration. The energy regulator Ofgem announced that its price cap would fall 7% from April to the equivalent of 1,641 orange for a typical annual dual-fuel household. Energy costs were supposed to stabilize. The worst of the crisis was supposed to be over. Households were supposed to get relief. All bets are now off. Cornwall Insight, the energy consultancy that tracks price cap projections, released updated forecasts on Wednesday. Their projection for the July to September price cap has increased to 1,801. That is up $160 from the April cap, a 10% increase in 3 months. And that is the optimistic scenario. Craig Lowry, Cornwall Insight's principal consultant, acknowledged that the market impact is still uncertain. What happens in the energy markets over the next 3 months will be the key factor, but the direction of travel is clear. Energy bills that were supposed to fall are now projected to rise significantly. The Resolution Foundation, analyzing the economic forecasts presented by the Chancellor on Tuesday, issued a stark warning. If sustained, these energy price rises could add over $500 to the typical household energy bill in the summer, and roughly a percentage point to inflation. £500 added to your energy bill by summer. 1 percentage point added to inflation. And this is coming on top of years of cost of living pressure that UK households have barely survived. The think tank said the economic picture before the war pointed to a typical working-age household being $300 better off over the next year. Unfortunately, the economic fallout from war in the Middle East could erase this completely. Every pound of improvement that UK households were supposed to receive could be wiped out by energy price increases driven by a conflict thousands of miles away. Now let me show you how mortgage rates are being repriced in real time, because the financial markets move faster than the news headlines. The pricing of fixed-rate mortgage deals is largely dictated by money market swap rates. These are the rates at which financial institutions lend to each other for fixed periods. When swap rates rise, mortgage rates rise. The relationship is mechanical and immediate. 2-year swap rates had risen 26 basis points from 3.33% on Friday to 3.59% on Wednesday morning. 5-year swaps are up 21 basis points to 3.71%. These are 30-day highs in response to the conflict. The swap market is repricing mortgages before most households even realize what is happening. Adam French, head of consumer finance at Moneyfacts, described the impact. The financial turmoil has led to a rapid shift in interest rate expectations, with the impact on the mortgage market almost instantaneous. Some lenders have already paused or reconsidered planned rate reductions. Almost instantaneous. Lenders pausing rate reductions. The mortgage relief that was supposed to continue through 2026 is being withdrawn before it even arrived. If you were waiting for rates to fall further before refinancing, you may have missed your window. If you were planning to buy a home based on falling mortgage costs, your calculations are now wrong. The swap rate increases translate directly into higher mortgage costs. A 26 basis point increase on a $250,000 mortgage adds roughly $30 per month to your payment. Over a 25-year mortgage, that is $9,000 in additional interest, and the swap rates could rise further if the conflict extends and energy prices remain elevated. Now let me show you what is happening in the United States, because the American economy faces the same transmission mechanism from war to wallet. The average price for a gallon of gas in the U.S. rose to $3.19 as of Wednesday, up more than 22 cents from a week ago. 22 cents in 1 week. That is the war showing up at the pump within days of the first missiles being fired. Brent crude, the international oil benchmark, jumped above $85 on Tuesday to its highest level since July 2024. Some analysts suggest the per barrel price could surge above $100 if the Iran conflict is prolonged. Every $10 increase in oil prices adds roughly 0.2 to 0.4 percentage points to consumer inflation over the following year. A move to $100 would add roughly 0.6 percentage points or more to inflation that is already running above the Federal Reserve's target. Energy costs in the U.S. have already increased over the last year, even before the war. Electricity prices increased 6.3% in the 12 months ending January 2026, more than double the headline inflation rate of 2.5%. Average residential electricity costs rose from just under 16 cents per kilowatt hour in January 2025 to nearly 18 cents per kilowatt hour in November, an 11.5% increase. The energy burden on American households was already building. The war adds to it. The RAC in the UK provided projections for petrol prices based on oil scenarios. If oil stays around current levels near $81 a barrel, the average price of petrol should not rise much above 136 pence per liter. But if oil goes to $90, it would be more than 140 pence. And $100 oil would take it nearer to 150 pence per liter. 150 pence per liter. That is the cost of filling your tank rising by roughly 10% or more. That is money out of household budgets that could be going to food, to savings, to debt repayment. Instead, it is flowing to oil producers because of a war that households have no control over. Now let me show you what the Federal Reserve is saying, because the central bank response to all of this remains deeply uncertain. Federal Reserve Bank of Minneapolis President Neel Kashkari said Tuesday he had a lot of confidence about the U.S. economic outlook before the U.S. launched attacks on Iran. But he noted there was uncertainty about interest rate cuts, as it is unclear whether energy prices would continue rising, potentially affecting inflation. Kashkari said it was too soon to estimate the impact the conflict could have on inflation, and could depend on how long and how bad the war becomes. Too soon. How long? How bad? These are the words of a Federal Reserve official acknowledging that the central bank does not know what is happening and cannot predict what comes next. Federal Reserve Bank of Cleveland President Beth Hammack told the New York Times it was too early to gauge the impact of the Iran war. Despite the conflict, she said she supported holding interest rates steady for quite some time. The Fed is paralyzed. They cannot cut because inflation might rise from energy costs. They cannot signal hikes because the economy might weaken from the war. They can only hold and watch. The CME FedWatch tool shows the combined odds for a rate cut at the Fed's July meeting at 54.7%. That is barely better than a coin flip for rate relief by summer. The probability is much lower in March and April, with odds of just 2.7% and 12.8% respectively, before rising to 37.4% in June. March is essentially zero chance of a cut. April is nearly zero. June is only 37%. July is barely over 50%. The rate cuts that American borrowers were counting on are being pushed further and further into the future, and may not arrive at all if energy prices remain elevated. Now let me show you what is happening in Japan, because the Bank of Japan is doing something that makes no sense until you understand the broader picture. The Bank of Japan remains committed to its plan to increase interest rates, with April being a potential time frame for this move. While the Fed is frozen and the Bank of England is backing away from cuts, Japan is planning to raise rates. They are moving in the opposite direction from where energy shocks would suggest. Why? Because Japan has been fighting a different battle. For decades, Japan fought deflation, falling prices that depressed economic activity. They kept rates at zero or negative to stimulate spending and investment. Now inflation has arrived in Japan, and the central bank sees an opportunity to normalize policy. But the Iran war complicates this calculus. Higher energy prices feed directly into Japanese inflation because Japan imports virtually all of its oil. Energy cost inflation could push headline inflation higher, which might actually support the case for rate hikes. But energy shocks also damage economic growth, which might argue for holding rates steady. The Bank of Japan is in a different position than Western central banks because its starting point is different. It has room to raise rates from near zero. Western central banks have already raised rates significantly and have less room to maneuver. Japan's April rate hike plan shows that central banks are not all facing the same constraints. But Japanese households will still feel the energy price impact, just like households everywhere else. Now, let me show you what happened in stock markets because the equity reaction reveals how investors are processing the uncertainty. The UK's FTSE 100 share index lost about 3% of its value this week, falling sharply on Monday and Tuesday, before recovering a little on Wednesday. 3% in a week is significant but not catastrophic. Markets have experienced worse during previous geopolitical shocks. But the advice from investment professionals is notable. Don't panic. Unless you need to sell your shares or fund holdings, at which point you crystallize the loss, you will not have lost any money. If you can stay put until prices recover, you will be back where you were, or hopefully in an even better place. Gemma Slingo at Fidelity International says staying invested throughout times of volatility is the best strategy. When markets hit rocky waters, jumping in and out should be avoided. Otherwise, you run the risk of missing out on unexpected opportunities that might arise from market corrections. Susanna Streeter at Wealth Club said investors have been bracing for a rise in geopolitical tensions, and now they are having to buckle up for another roller coaster ride. However, for those in it for the long term, big bumps in the road are part of the journey. The historical data supports this calm approach. LPL financial analysts wrote that across more than 24 geopolitical events since World War II, the S&P 500 averaged a one-day decline of about 1%. Markets tend to absorb shocks quickly before stabilizing and recovering within a matter of weeks. The S&P 500 dropped 1.2% when Iran attacked Israel in April 2024 and took just over 2 weeks to recover the loss. The underlying state of the economy, such as the health of the job market, interest rates, and inflation, matters more than the event itself. That is the key insight. The war is dramatic. The headlines are alarming. But the fundamental economic conditions determine long-term market performance more than any single geopolitical shock. The challenge is that the war affects those fundamental conditions. It raises energy prices, which feeds inflation, which affects interest rates, which impacts the entire economy. The war is not separate from fundamentals. It is changing fundamentals in real time. Now let me show you what this means for your pension, because even if you do not own individual stocks, you are exposed to market movements. Workplace pension schemes and personal pension plans invest in stock markets, alongside other assets such as property and bonds. If you are in a defined contribution scheme, how much your individual pension is worth will depend on the performance of these investments. Younger people's pension cash is often put into riskier investments, partly because they have a longer time to retirement. This means younger workers may see more volatility in their pension values during the current crisis. As you get closer to retirement age, your scheme will usually start moving you into less risky assets such as cash and bonds. For pensioners using pension drawdown, a way to take money from a defined contribution pension, this may not be a good time to sell investments to produce an income. If you are selling into a down market, you are crystallizing losses that could recover if you wait. The pension impact is one of the most hidden consequences of geopolitical shocks. Most people do not check their pension values daily. They may not realize for months that the Iran war affected their retirement savings. By then, the impact may have reversed, or it may have deepened. The uncertainty extends across every time horizon. Now let me show you the scenarios that economists are modeling, because the range of outcomes remains extremely wide. Tom Porcelli, chief economist at Wells Fargo Economics, wrote that the firm's projections of an up to 30% increase in oil prices do not come close to creating a recession or disrupting inflation. Absent a prolonged war, the conflict's impact on the U.S. economy, inflation, and monetary policy should remain modest. That is the optimistic scenario. Oil rises 30%. Inflation ticks up temporarily. The economy continues growing. Monetary policy adjusts at the margin, but does not fundamentally change. The war is a bump, not a crash. Oxford Economics chief economist Ryan Sweet wrote that the conflict doesn't have a significant impact on the global economy, but he warned there's a growing risk of disruptions piling on top of one another, amplifying the hit. That is the moderate concern. No single shock is catastrophic, but multiple shocks compound. Tariffs plus oil spike, plus supply chain disruption, plus currency volatility. Each adds a little to the burden. Together they could create meaningful damage. Christian Kerr, an analyst at LPL Financial, wrote that any sustained disruption to oil and natural gas flows has the potential to influence inflation expectations, weigh on business confidence, and elevate volatility across asset classes. That is the key variable. Sustained disruption. A 2-week war with a quick resolution looks very different from a 6-month conflict with ongoing supply disruption. The difference in economic impact between those scenarios is enormous, and nobody knows yet which scenario will materialize. The NISR modeling for the UK shows what sustained disruption looks like. Oil up 30% and gas up 50% for 1 year pushes interest rates to 4.5%. That is not a mild outcome. That is a reversal of all the progress made in 2025 toward lower rates. That is mortgage costs climbing back to levels that crush household budgets. Now let me show you what assets might perform well in this environment, because not everything loses during war and energy shocks. Assets such as gold and more defensive stocks, including utilities, healthcare firms, companies selling consumer staples, and those with reliable high-yielding dividends tend to be more resilient in eras of unpredictability. That is the guidance from investment professionals trying to help clients navigate the current environment. Gold has approached record highs this year. The precious metal benefits from both inflation fears and geopolitical uncertainty. When energy prices rise and wars rage, gold provides a store of value that does not depend on any government's fiscal discipline or central bank's monetary policy. Energy stocks benefit directly from higher oil and gas prices. Oil companies see their revenues rise when crude prices spike. Natural gas producers benefit from European price increases. The sector that causes inflation benefits from inflation. This is one of the ironies of the current moment. Defensive sectors like utilities, healthcare, and consumer staples benefit because demand for their products and services does not decline much during crises. People still use electricity. People still need medical care. People still buy groceries. These companies generate steady revenues regardless of what happens in Iran. High dividend stocks provide income that persists through volatility. If the underlying company continues paying dividends, shareholders receive cash flow regardless of what the stock price does day to day. The income provides a cushion against capital losses. But for most households, the question is not how to profit from the crisis. The question is how to survive higher energy bills, higher mortgage costs, higher petrol prices, and stagnant or declining real wages. The investment strategies help those with significant portfolios. They do not help the family trying to pay for heating this winter. Now let me bring all of this together because the connections between war and wallet run through every dimension of household finance. The transmission mechanism works like this. War creates uncertainty about oil supply, oil prices spike, higher oil flows through to petrol prices within days, higher oil flows through to natural gas prices regionally. Higher energy costs flow through to transportation, manufacturing, agriculture. Inflation rises across the economy. Central banks see higher inflation. They hold rates steady or raise them instead of cutting. Higher rates flow through to mortgages, credit cards, car loans. Household borrowing costs rise. Disposable income falls. Living standards decline. Every link in that chain is now active. Oil has spiked. Gas has risen. Petrol prices are climbing. Swap rates have increased. Mortgage lenders are pausing rate reductions. Rate cut probabilities have collapsed. Energy bill forecasts have risen. The $300 improvement that UK households were supposed to receive could be completely erased, and the duration matters more than anything else. A 2-week conflict that ends with diplomatic resolution allows the chain to reverse. Prices stabilize, markets calm, rate cut probabilities recover. Relief arrives, delayed but not eliminated. A 6-month or year-long conflict with sustained supply disruption keeps the chain activated. Prices remain elevated. Inflation stays high. Rate cuts become impossible. The 4.5% interest rate scenario that NISR modeled becomes reality. Households face a new cost of living crisis, just as they were emerging from the previous one. Fed officials saying too soon to gauge is not reassuring. It is an acknowledgement that the central bank does not know which scenario will materialize. They are waiting for data that does not exist yet. They are hoping for resolution that may not come. And while they wait, households pay higher prices. The Bank of Japan maintaining its April rate hike plan shows that some central banks are moving forward regardless. Japan has its own inflation problem to address. But for UK and US households, the paralysis of their central banks means no relief is coming. Quite some time, as Beth Hammack said. Rates stay elevated for quite some time while energy costs pile on top. Now let me show you what to watch for, because the coming weeks will determine which scenario we are living through. Watch oil prices. If Brent crude stabilizes below $85, the moderate scenarios are more likely. If it pushes toward $90 or $100, the severe scenarios become more probable. Every $10 matters. Every sustained increase matters more. Watch natural gas prices in Europe. If they stabilize, the UK energy bill projections could moderate. If they spike further, the $500 household cost increase becomes reality. Europe's vulnerability to gas supply disruption is a key transmission mechanism for UK cost of living. Watch diplomatic signals between Iran and the US. If back-channel talks progress, if resolution appears possible, markets will price in shorter conflict duration. If talks collapse, if escalation continues, markets will price in longer conflict and higher sustained prices. Watch central bank communications. If the Fed or Bank of England signals they are looking through energy price increases as transitory, rate cut hopes revive. If they signal concern about embedded inflation, rate cuts become even less likely. Watch the data. Inflation readings in coming months will show whether the energy spike is flowing through to consumer prices. Employment data will show whether economic activity is being damaged. The data determines the narrative, and the narrative determines policy. I am not a financial advisor, and nothing I say should be taken as financial advice. But what I can tell you is that the Iran war has already begun affecting your finances, not in theory, not in projections, in actual market prices and rate expectations that determine what you pay. Rate cut probability collapsed from 80% to 30% in 72 hours. 2-year swap rates rose 26 basis points. Mortgage lenders paused planned reductions. Energy bill forecasts rose $160 for July. Gas prices climbed 22 cents in a week. The FTSE lost 3%. All of this happened while most people were watching the war coverage, not the financial coverage. By the time they notice the impact, it has already materialized. The bills are already higher. The rates are already repriced. The relief that was supposed to arrive has already been withdrawn. The war in the Middle East is not just a foreign policy crisis. It is a household finance crisis that affects every family that pays for energy, borrows money, or depends on economic growth for their livelihood, which is everyone. Subscribe to Market Acme right now and join our WhatsApp community for real-time updates, because the war's financial impact is evolving by the day. Energy prices move overnight, swap rates reprice continuously, central bank expectations shift with every statement, and your household budget is being affected whether you are watching or not. I am Kenzo John. I am not a financial advisor. This is Market Acme, and I will keep showing you how the war translates into your energy bill, your mortgage payment, your petrol cost, and every dimension of your household finances that depends on stability that no longer exists. The war is thousands of miles away. The financial impact is in your wallet right now. Rate cut probability collapsed. Energy bills rising, mortgage rates repricing, living standards threatened. The $300 you were supposed to be better off could be erased completely. The rate cuts you were counting on may not arrive. The energy relief you expected is reversing, all because of a conflict you cannot control and a transmission mechanism that connects oil wells in the Persian Gulf directly to your household budget. Join our WhatsApp community for updates, because when the next energy price projection arrives, when the next rate probability shifts, when the next central bank statement signals what rates are doing, you need to understand what it means for your money immediately. The war tax is being levied right now, not through legislation, through markets, through energy prices, through interest rates, through every mechanism that connects global events to household finances, and the only protection you have is understanding the transmission mechanism before the bill arrives at your door.